Hello, everyone, and thanks for joining us for another episode of Secure Act 2.0. In the first one we did a couple of weeks ago, it was designed more for the employees themselves, the participants of retirement plans, as far as some of the rules and provisions that went into the Secure 2.0 Act. Today, we're going to talk about the provisions that relate to the plan sponsor, the decision makers, some things that people need to know. My name is Chris Caldwell with Highland Trust Partners. I appreciate everybody joining us today. It is Groundhog Day, and just to let you know that Puxtony Phil is telling us it's going to be 6 more weeks of winter. So if you're in the mindset that you like to have a few more a month and a half or so more of cold weather, then the groundhog gave you what you wanted. Today's episode is recorded, so we will be sharing this to everyone through email, and it'll be on our YouTube channel. So we hopefully will get this out to anybody who has not on this call today and would like to see it or hear it, and also share it with other people. Feel free to do that. It's for plan sponsors, business owners, CPAs, anybody who has their access connections into maintaining retirement plans for employees. So please feel free to share it. There is no chat room open, so no questions online. You'll have to contact us directly, and I hope you have plenty of those. So we're here to help. We're here to share as much information as we possibly can with you. There's also no slide deck. So I just have one title slide up on this recording, but there's no slide deck, so feel free to multitask, do what you want to do with a headset in your ear, and just get some good information from this. So there's about 10 things we're going to go over. We'll 10 or 15, 10 to 12 minutes or so maybe to get through them. Some of them pretty high level because I want to for people to ask us questions. But one I've gotten a lot of questions about is a student loan repayment. So there is a provision in Secure Act 2.0. It's an optional provision that begins in 2024, if people choose, or later, that will allow their employees who have student loans to, while they make a payment to their loan, that payment will count as almost a contribution, if you will. It doesn't really go into their 401k account, but it counts in the calculation for a contribution to get an employer match. So basically, we'll say if I put $500 out of my paycheck, and if I had a student loan, I put $500 out of my paycheck to pay the student loan itself, then that $500 will be counted towards the match for my company, and the company can put in a match on that $500 into my 401k account. So they're trying to obviously help those who have high student debt, and that's maybe a little bit of a showing their cards as far as not maybe thinking they can get around what they talked about doing during the elections is removing all student loan debt. Don't think that's ever going to happen, but this is a way they can allow employees to pay off loans. As well as get some retirement savings from the company. Match is optional. Again, you don't have to do it. It's obviously going to be designed for companies who have employees that either have student loan debt, or they're trying to recruit employees who may come from institutions that would carry debt with them. So I think more professional firms, CPAs, law practices, doctor practices. It probably is not the best use of a provision addition for manufacturing firms who only have maybe a handful of employees who would have a student loan outstanding, but they can still institute it if they choose to. The second thing I want to mention was increased catch-up contributions. So we all know now, or most of us know now, that if you're an employee over the age of 50 years of age, you can put an additional amount into your 401k account. In 2023, you can do $22,500 from your paycheck for the year, paychecks plural, for the year into your 401k, and you have the ability to add another $7,500 because you're over 50 years of age. They're making a provision change to allow those in their 60s to do even more. So if you're between the age of 60 and 63, and this begins in 2025, if I didn't say that already, then you're allowed to put an additional put an additional increase from your paycheck into your catch-up, into your 401k account. So you're allowed to do that between the age of 60 and 63. One thing they added, though, which actually this starts sooner than this, starts in 2024, is if you're considered a highly compensated employee, and in their definition, it was $145,000 adjusted gross income. So if you have and talk to your CPA about that, obviously, but if you have $145,000 or more in adjusted gross income, you're considered highly compensated, and you can still do a catch up, but it has to go into a Roth bucket. It cannot go into a tax deferred bucket. So if you have a plan outstanding that you have employees that do catch up contributions at age 50, or will obviously be in their 60s and do them as well starting in 2025, you have to have a Roth provision built into your plan. If you don't, the understanding is you can't allow any of your employees to do catch-ups. This will be eliminated from your plan altogether. So you're going to have to, if you don't have a Roth, that's one thing you're going to need to work on in the next year or so, is to make sure that that provision is added, that you have that Roth component. The third item to go over real quick is emergency savings account, ESA. It's an optional provision. It begins in 2024 if people choose. It allows employees to actually save into a savings account as part of their retirement plan. So out of their paycheck, they can have dollars go into a savings account. It maxes out at $2,500. It must go into the Roth bucket. It can't be deferred, so it must go into Roth. And there's some rules about when they can take how they can take money out and things such as that. There's no verification needs for employees to tell the employer what they're using the money for. It's truly for what they consider it as an emergency. And it's a way for particularly employees who have always had trouble saving in retirement because they're scared to death, and sometimes rightfully so, they may have to tap into it, which they're not allowed to pull money out for emergencies. This will be a way they can stash some money away and know that a portion of it is still available for emergencies if they get in a fix. So I could see easily employers who have a workforce with this maybe a lower income as on average would benefit from this. Optional, so something you probably want to talk to someone about to see this, to add that in 2024. The next optional provision is a Roth employer contribution. So beginning this year, actually, it's if you can allow the match from the company to go into a Roth bucket for the employee if the employee chooses. Traditionally, over all the years, even if employees were doing Roth contributions only for themselves, what the company put in for them had to go into the tax deferred bucket. So they'd have two buckets in their 401k account. Now companies have the option to allow the employee to choose. They can either have the match go into deferred, or they can have the match go into Roth. In my mind, I see it being a benefit to add it to the majority of plans. I'm sure there's going to be exceptions to that for some, but if all plans really need a Roth component anyway, just for the catch-up provision, allowing employees to be able to choose where their company money goes as far as Roth versus traditional deferred, it makes sense to me. The fifth provision is automatic enrollment and increase. Now, I've got several questions on this one. If you have a plan in place now, your grandfather, you're not going to be forced to implement an auto increase or auto enroll. But beginning now, if someone starts a new plan, startup plan or whatnot, they're going to have to start in 2025 is that a provision that is auto enroll and auto increase. That's going to be a requirement going forward. Employees can opt out of that, but as the employers, we have to have that as a provision if we're starting a plan now. Again, plans that have been in existence the last number of years, your grandfather, and you don't have to do anything. Number 6 is there's a new provision under what's considered long-term part-time employees. So for years, a part-time employee was 1,000 hours, 12 months of service. Over 12 months, if they meet that, they had to be allowed to participate in the 401k plan. Secure Act 1.0 made it 500 hours over 3 consecutive years. Now, starting in 2025, a couple of years, Secure Act 2 says it's 500 hours, but 2 consecutive years. So if you have a good many part-time employees starting in 2025, if they hit 500 hours over 2 consecutive years, then they have to be allowed to enroll in the plan. Does not mean you have to match. People get confused on that one. It just means you have to allow them to put money into their own money into the plan. So that's coming up in a few years. Increased voluntary cash outs. So begin in 2024, next year, they're increasing what's a voluntary cash out. So this is where if you're a client of ours, you've seen us talk about this every year in an audit or in our reviews. If former employees, terminated employees have balances less than $1,000, we try to get them out of the plan. We contacted them, sent them notices, tried to get them to roll it out. If they didn't answer, we send them checks just to get them out of the plan. If they had balances between $1,000 and $5,000, we we'd open IRAs inside of the record keeper. Most record keepers have IRA. It will allow individual retirement accounts. So between 1 and 5, we'd roll them to IRAs in their name. What 2.0, Secure Act 2.0 has done is increase that from 5,000 to 7,000. So employees have between $1,000 and $7,000 as a balance, former employees are in their 401k plan. We can look at moving them into IRAs to get them out of the plan. There's been the eighth point I wanted to make, there's been some additional distribution allowances. So one is 2026, a few years away. Employees can pull out small amounts, and they are pretty small, to help pay for long-term care premiums, insurance premiums. There's some rules around this, so we got a few years to worry about it, but we can talk about this at a future point if you want to, because they may adjust this over time. We don't know, because basically what they're allowed to take out to make these payments not very big, and long-term care insurance is very expensive. Employees can take withdrawals out now, starting this year, for terminal illness, which is completely fair. That's understandable. In 2024, they're allowed to take emergency withdrawal of up to $1,000. That's totally different from the ESA, the emergency savings account I mentioned earlier. You can have both, but this one is for anybody. Doesn't matter of their income status. Again, the emergency savings account was for employees that were non-highly comped. With highly comped can't do an ESA savings. But on the emergency withdrawal, $1,000, anybody can do it whenever they want to, for whatever reason they want to. The other couple of domestic abuse, you can take withdrawals for domestic abuse and disaster relief, which are basically, they did make some additions as far as to provisions for employees to remove money from their plans should an emergency, other types of emergencies or things happen, which is completely understandable. Those are good changes to plans. There was an RMD change. I think most people knew this. I talked about this on our last Zoom meeting with individuals. It has gone now from 72 to 73. That started this year. It increases to 75 in 2035. Now, I will easily say that that's not, there's a lot can change between now and 2035, but in 2035, it goes to 75. There's reduced penalties if people miss their RMDs. So it's not 50% penalty anymore. It's 25%, and it can go down to 10% if they file timely or report it timely. And the other thing is there's no longer RMDs in Roth buckets in retirement plans. That was something that was missed years ago when they allowed RMD or allowed Roth accounts in 401ks, 457 and 403B plans, that if you had a balance in Roths in company plans, you still had to take an RMD at RMD ages. That's gone. So now Roth anywhere, individual or in company plans, there's no RMDs. They just fixed something they should have fixed years ago. So that was good. And the last thing, just to quickly mention, is a few notices, which I know everybody who does plan sponsors who is in charge of sending notices out to employees would be thrilled about. And I started this year. So former employees or employees that aren't participating, a lot of the notices that used to have to go out to everybody, regardless if they're in the plan or had any type of balance in the plan, had to get a bunch of notices for any little changes, provision changes, investment changes, anything. Most of those are gone. There's a few that have to go out every year to everybody, but now the majority of notices are only to people who actively participate in the plan, which is fantastic for you who are plan sponsors in charge of doing those types of things. So those are 10 quick points. Went pretty fast through them. I want to get this. I didn't want to take up too much of your time. If there's any of those that have interest of you, some you have to do, some are optional, please contact us. We will definitely want to make sure that you have a place that you can turn to get your questions answered. Our generic Highland Trust email address, htp@highlandtrustpartners.com, goes to our team. You can ask it on there. You can contact us directly. Most would have my contact information, or anybody else on our team visit our website and get that if you don't have it. And we're happy to review these with you to make your lives easier and make this better and make the plans better for your employees, which is what we really do this for. Okay, so recording will be out soon, and share this with anybody you want to. And I hope everybody has a wonderful day, and don't be a stranger. Thanks so much. Bye.